Hello everyone, welcome to another video. And in this video, we are basically going to continue discussing chapter number 20 from the book Psychology of Money, written by Morgan Housel. And if you remember, in this chapter, we are basically discussing the author's psychology of money, like how he thinks about money and how he thinks about investing. And specifically, what we're going to discuss in this chapter is how his family thinks about investing. So, the author started his career as a stock picker, and then in the beginning, he owned a few individual stocks, individual big company stocks like Berkshire Hathaway and also P&G. And he also had a collection of smaller company stocks as well. So in his 20s, he basically had around 20 or so stocks, 20 or so different stocks, right? Um, and then the author reflects, like, with this strategy, did he actually manage to beat the market? Did he manage to beat the market in a way that he was making more money than the market average? And to that he replies that that was not the case actually. Mm, he didn't outperform the market average. So then he decided to move on to a different investment strategy, which was to invest in low cost index funds. Um, so he also says he doesn't have anything against picking individual stocks. But the thing is, uh, there is a very few percentage of people who can actually outperform the market averages. It's very hard. It's harder than what people actually think. So he says if he had to summarize his view on investing, it's basically every investor should pick up a strategy that has the highest odds of successfully meeting their goals. Uh, and he also thinks that for most of the investors, the best strategy to basically increase their odds of success is to do a dollar cost averaging into a low cost index fund as he does for himself, and that will basically give them the highest odds of long-term success. And then he dwells into why is it actually hard to beat the market. And the reason it's hard to beat the market is that if it was easy and if the odds of success were high, then everybody would be doing it, right? And if anybody can do it, then what basically happens is that there is no opportunity in a way. So, so it should be no surprise for most of the for the people that majority of those trying to beat the market actually fail to do so. Around 85% of large cap active managers actually did not beat the S&P 500 over the decade ending in 2019. So then he discusses about how did he actually came up with this came to this investment strategy to just basically invest in low cost index funds. So he basically realized that whatever financial goals he has, they can be met with investing in the low cost index funds. And his financial success, basically, as we discussed in the earlier video, is to have independence, the financial independence, and also what basically helps him to achieve the financial independence and also gives him confidence in investing in a low cost index fund is his uh, lifestyle, his frugal lifestyle of living. So he says, like, if I can achieve that financial goal without taking any additional risk, then why would he basically even try to beat the market? So that is his thinking, that is his philosophy. And then he discusses that he has a very firm belief that in finance, there is very little correlation between how much effort you put into investing and how much outcome you're going to get from that effort. And the reason behind that is, as we have seen in the previous chapters, is that the market is basically driven by a very few tail events. Um, and those tail events, as we have seen before, they basically account for the majority of the returns. So the thing is, like, it doesn't matter if you have been trying really hard in investing to beat the market, but if you just miss those key tail events, then it's not gonna give you anything back basically. So all of your effort is for nothing. And it's also true in the reverse. So when your investment strategies, your simple investment strategies, um, can work great as long as they capture the few things that are important to that strategy's success. And then the author goes into his investment strategy, that it doesn't rely on picking the right sector or the timing of the next recession. It basically relies on high levels of saving, some patience, and optimism that the global economy will basically do better in the coming decades. So that is author's philosophy, his the way he thinks about investing. Pretty straightforward, and he suggests that for most of the people, it should work as well if you want to let compounding do its magic. And as we have seen, that trying to beat the market is not as easy as it sounds. So this is basically the end of the book, Psychology of Money. It took us, I don't know, like 45, 50 videos to get here. But this was a journey and I really enjoyed it. I learned a lot along the way. And hopefully you also learned something here. And I will keep on creating videos, but with different topics, with different books, and hopefully get better along the way in doing so. And thank you for watching. Whoever watched, not too many right now, I know. But yeah, I'll see you in the next one. Bye bye.